Welcome to What the is going on with the economy, the #1 personal finance and economics newsletter for people living abroad, powered by Abroadin. I'm your host, Elliot Locke. Let's get into this week's episode. This week, we're looking at why tech stocks are doing poorly despite the AI boom. Starting off, the Netherlands wants to tax unrealized investment gains, and here is what you should know. Late last week, the Dutch government announced an upcoming change to taxes in the Netherlands. Soon, the country plans to tax unrealized capital gains to most investors. An unrealized gain is a profit you have on paper or on your investing app screen, but not in your bank account. In other words, your investment might be profitable in theory, but until you sell it and lock in or realize that gain, it doesn't actually exist yet. For reasons that aren't quite clear to us, or many others, for that matter, Dutch investors will now have to pay an annual tax on any gain in their portfolio, regardless if they've actually sold and made a profit or not. We have a lot of thoughts on this, and for the record, most of them are quite negative. We'll break this down more as details about the new rules emerge, and if you follow me on LinkedIn, I might be ranting about it there before my thoughts find their way to this podcast. Until then, if you're a taxpayer in the Netherlands and have nearly any form of investment portfolio, this could have a profound impact on your financial planning. We'd suggest paying close attention to how these rules finalize and rethinking your wealth-building strategies or even long-term plans to stay in the Netherlands sooner rather than later. Next, we ask, would you lend AI money? Or, why tech stocks have been doing so poorly lately? If you run a publicly traded company and you're not in the tech industry, 2026 has almost certainly been a good year for you so far. Your share price is up, investors keep pouring money into you, and despite geopolitics throwing everything it's got at you, you're still on a somewhat upward trajectory. If you're the head of a tech company trading on the stock markets, 2026 probably couldn't be more different. Since the beginning of the year, your share price has taken a beating while your balance sheet has ballooned with debt. From the outside, it's probably surprising. Tech, and specifically artificial intelligence, is at the top of nearly every conversation, article, and newsletter. With the tech industry booming and analysts and evangelicals all waxing poetically about the bright AI-powered future, why would tech stocks be down? From the inside, it's beyond clear. Tech companies are in an arms race, and the only way to win is to build at all costs, including by borrowing money. This is exactly why the stocks for giant tech companies like Microsoft, Oracle, and Amazon have all seen their share price fall by over 10% since the beginning of the year. A boom needs money, and credit markets have more of it than stock markets do. It's becoming clear that, for better or for worse, AI is the future of tech and increasingly our economy. Tech companies providing these services are migrating from software developers to infrastructure providers. The financing and economics of software and infrastructure are wildly different. The economics for software are fairly clear-cut. Tech companies can, in theory, create an unlimited amount of their software for the same development costs. Once they recuperate their investment, profits grow with only minor expenses to maintenance and distribution hitting the balance sheet. The SaaS model, or software as a service, is the textbook definition of this phenomena, with hockey stick growth charts motivating tech founders and startup investors alike. Infrastructure is the opposite of SaaS. Building data centers and filling them with servers and other computers is capital intensive and has physical limits to their scalability. The problem for tech companies is that, to deliver on their promise to be the AI leaders of tomorrow, they need powerful computing infrastructure today, and lots of it. To fund this build-out and to access the data centers that already have the infrastructure in place, tech companies are turning to the bond markets to borrow vast sums of money. In 2025 alone, Microsoft, Amazon, Alphabet, Google, Meta, Apple, and Oracle borrowed a combined estimated $100 billion just for AI infrastructure. Yet the boards of these companies don't think it will be enough, with some estimates projecting that AI infrastructure-fueled borrowing this year could easily blow past 2025's figures. Looking at why stock investors are selling off their tech holdings, we see several factors at play. Despite tech's role at the center of AI, investors aren't convinced right now on the metrics and near-term profitability of these hyperscaling tech companies. For one, many analysts and investors already believe that tech companies have been largely overvalued recently. When investors think a company is overvalued, it generally means that their share price is far too high relative to their profitability, meaning it will take far longer to recuperate their money than investing into other companies or industries. With these firms now taking on enormous debt, their ability to generate profit goes down further, since borrowers will need to prioritize paying back loans instead of paying shareholders dividends. Second, there's a growing consensus that we're witnessing a new railroad era. 175 years ago, as rail technology became more viable, there was an unprecedented rush to connect the globe with railways. This boom required enormous sums of money to not only build and lay the tracks, but also create the trains and other infrastructure needed to bring rail to reality. It was an exciting time, but also an incredibly risky one for investors and railway entrepreneurs. More firms went bust than were successful. By the early 1870s, the hype had burst, with a railroad bubble largely responsible for the Panic of 1873 and resulting in a 4-year depression that took nearly 20 more to get out of. Perhaps investors are wising up and looking to diversify elsewhere. After all, markets are far more advanced and diversified than they've ever been, and are near unrecognizable compared to the first days of railways. They could also be looking at other ways to get exposure to the AI boom. Instead of funding a borrowing spree, some investors are getting in on the receiving side of this debt-fueled buildup. For example, the exchange-traded fund DTCR tracks and invests into an index of data centers and digital infrastructure companies who are the backbone behind the AI boom. Unlike the funds tracking tech companies, DTCR has had a wonderful year so far, rising nearly 11.5% since the beginning of January. Not coincidentally, it has a negative correlation of negative 0.23 with XLK, an ETF tracking only the tech companies in the S&P 500. Negative correlations between stocks or investment funds means that if one is going up, the other one is generally going down. It also shows the power of diversification and why it's so important for investors of all stages, including individuals who might just be getting started on their wealth-building journeys, to avoid concentrating their money in one place. Wrapping up with a broad news and updates. Our next workshop on how to map, track, and stay on top of your bank, pension, and wealth accounts when living abroad is coming this Thursday, February 19th at 5 p.m. Barcelona time, and you're invited. We're covering our tips and techniques to stay on top of your accounts spread around the world. Registration is free and all signups get access to the replay. We are also running a late Valentine's Day one-on-one session sale. For €99, you can sit down with one of our experts to walk through your financial plans and hurdles. Check the show notes for links to both of those. Compliance note. The information in this podcast is for educational purposes only. It does not constitute a personal recommendation to buy or sell any of the investments or assets mentioned in this episode. That's it for this week's edition. Thank you for joining us. Thank you also to our sponsor, Abroadin. If you like what you heard, be sure to subscribe so you never miss out on all of our updates. From the entire team, I wish you a good one, wherever you may call home.